A practical guide to smarter investing using 20 timeless insights. Successful investing is built on patterns of wisdom discovered over time. The first principle is to always demand a margin of safety. By buying assets at prices well below their intrinsic value, there is a built-in buffer against mistakes or unexpected downturns. Second, stay within a circle of competence. Invest only in businesses or industries that are well understood, where judgment can be sound and informed. Third, build a broad set of mental models. Draw on ideas from disciplines like psychology, history, mathematics, and economics, and use them to strengthen decision-making. Fourth, recognize reflexivity. Markets are influenced not just by fundamentals, but also by shifting investor expectations and feedback loops. Fifth, focus on what is personally familiar. Often, opportunities arise in areas where everyday experience provides useful insights into how products and services are gaining traction. Sixth, have the courage to buy when valuations are extremely depressed. Periods of market panic often create once-in-a-generation bargains. Seventh, be willing to act as a catalyst. Sometimes, real value is unlocked only when shareholders demand better strategies or governance. Eighth, use data and quantitative tools where appropriate. Mathematical models and statistics can uncover patterns that are hard to see otherwise. Ninth, apply systematic approaches to stock selection. Simple rules based on profitability and valuation can help identify companies that are both high quality and fairly priced. 10th, recognize the value of broad-based, low-cost index funds. They provide long-term stability and ensure that compounding works steadily in the background. 11th, do thorough research beyond financial reports. Speak to customers, suppliers, and competitors to form a full picture of how a business really operates. 12th, learn to follow major trends while they last. Large market moves can persist longer than expected, and aligning with them can generate strong returns. 13th, take a contrarian stance when the crowd becomes overly pessimistic. Stocks that are deeply out of favor often rebound as conditions normalize. 14th, practice second-level thinking. Instead of asking only what is obvious, ask what most investors are missing and why. 15th, balance the portfolio for resilience. Diversify across asset classes so that it can weather different economic environments. 16th, incorporate both technical signals and macroeconomic context. Studying price action alongside the larger economic picture strengthens predictions and decisions. 17th, concentrate capital when conviction is highest. Exceptional opportunities should be backed with meaningful investments rather than being diluted across too many positions. 18th, use short selling or buying put options cautiously to address overvaluation or misconduct. While risky, it can serve as both a hedge and a source of profit. 19th, have the discipline to hold fast to well-founded analysis, even if it is unpopular. Some of the most important opportunities come from spotting risks or mispricings others prefer to ignore. 20th, embrace technology and innovation. Data analysis, automation, and efficient execution are increasingly central to modern investing. The power of these 20 insights lies not in treating them as isolated rules, but in knowing which apply in a given situation. At times, patience and diversification matter most. At other times, concentrated conviction or contrarian courage is key. By integrating these lessons and applying them with discipline, an investor can build a framework that adapts to the ever-changing nature of markets.